We define corporate failure as the inability of a corporate company to consistently meet its corporate objective. If the corporate objective is to make profits, the inability of a company to consistently make profits is called corporate failure. We look at the causes of financial distress, because financial distress will give rise to corporate failure. We explain revenue failure, cost failure, failure in liability, failure in asset management, failure in liability management, and failure in capital management. Thereafter, we look at corporate failure prediction model. We have the quantitative model. The quantitative model is based on the assumption that corporate failure occurs because the company is having financial problems. The quantitative corporate failure model is based on the assumption that corporate failure occurs because the company is having financial problems. Therefore, we can use, if the causes of corporate failure are financial problems, then according to the quantitative corporate failure prediction model, we should be able to use financial ratios to predict company at the risk of corporate failure. Let me repeat that point. The quantitative model says that if company fails, because of financial problem, then we should be able to use financial ratios to predict companies at the risk of corporate failure. We have the second model, qualitative corporate failure prediction model. This model criticizes the first model, the quantitative model. The qualitative model argues that company fails not because of financial problem. So the qualitative school of thought, financial models are the consequences of corporate failure, not the causes of corporate failure. They now explain the main causes of corporate failure. That the main causes of corporate failure are non-financial problems, such as defect in management. When you have defect in management structure, for example, an inexperienced managing director, that's a defect in management. An autocratic managing director, that's defect in management. A passive board of directors, that is defect in management. Management that cannot identify changes in the business environment and cannot respond to changes in the business environment. That is part of management defects. So the qualitative school of thoughts, company failed because there were defects in the management. And these defects are non-financial. We talk about defects in accounting and errors in decision making. We look at the symptoms of corporate failure last week. Then we looked at how to avert corporate failure. Thereafter, we discuss capital reconstruction. And I remember saying that these two topics are closely related. When a company is at the risk of corporate failure, when a company is experiencing financial crisis, it is logical that the director of such company will not fold their hands. The directors of such company must take necessary actions to try and save the company from eventual collapse. Imagine yourself as part of a management of a company, and the company is experiencing financial crisis. Definitely, the management of which you are part of, you guys must look at actions that could be taken in order to salvage the business from liquidation. There are several actions that could be taken. One of them is capital reconstruction. Please, I will appreciate you listening carefully. This topic is something you meet in practice. There are several actions the management will consider if a company is experiencing financial difficulties. One of these actions is capital reconstruction. We now define capital reconstruction as the reconstruction of a company's capital structure. It is usually done where a company is experiencing financial difficulties and the possibility that the company will collapse is very high. The company directors may consider capital reconstruction. That is the reconstruction of the company's capital structure. This reconstruction might involve asset revaluation, raising new capital to the business, conversion of debt capital to equity, conversion of equity shares from one form to the other. The existing shareholders may be required to relinquish part of their shares or all of their shares. The purpose of capital reconstruction, we explained last week, is to find a way of allowing the company to continue in business and avoid insolvency and liquidation. Therefore, capital reconstruction is only worth considering if it is likely to be more beneficial to all parties than the liquidation of the company. I remember saying that if you are dealing with question on capital reconstruction, you are going to consider two positions. Position one, if the company is liquidated, what will the stakeholder benefit? Position two, if the company is reconstructed, that is, if the company is not liquidated, the company must be reconstructed as proposed by the director. What would the stakeholder benefit from the reconstruction? You can now compare liquidation position with the reconstruction position. We explained the principle of capital reconstruction last week. That reconstruction must not make creditor worse off. You can now ask yourself, who are the creditors? Anybody that has provided money to assist the business, particularly debt capital, they are categorized as creditors. It's a liability we have to pay. Long-term creditors or non-current creditors, non-current liabilities. Reconstruction must not make the creditor worse off than they will be under liquidation. Principle two, if you are trying to reconstruct a company, the purpose is to save that company from collapse. Therefore, there should be post-reconstruction profitability. It should be possible that if we reconstruct this company can continue in business and restore itself to profitability. Then we say reconstruction, principle three. The reconstruction scheme should be fair. The reconstruction scheme should be fair to parties involved. Later, we look at the steps involved if you are dealing with question on reconstruction. We have step one, state the three fundamental principles of reconstruction. Don't forget it. Step two, consider situation in liquidation. What that means is you are going to assume that if this company is liquidated, you are going to assume that if the company is liquidated and the asset disposed, who gets what? Meaning, if the asset is disposed, what will the stakeholder benefit from that disposal? How do we share the proceeds from the disposal? And I says, the proceeds from disposal, you cannot use your initiative to share it. The proceeds from liquidated assets cannot be shared based on personal initiative. The distribution of the proceeds from liquidated assets is based on the Bankruptcy Act. The Bankruptcy Act specifies how the proceeds from liquidated assets should be distributed. We explained this last week. You are going to start from preferential creditors. You now ask yourself, who are preferential creditors? At every point in time, you must be able to probe what you are being taught or what you are reading. Who are preferential creditors? Preferential creditors include unpaid wages and salaries, unpaid pensions, and unpaid taxes. Why are they regarded as preferential creditors? The law is trying to protect the employees. If a company is experiencing financial crisis, most likely that company will not pay staff salary again. The staff will be coming to office. They won't get salary. Watch out, companies that are experiencing financial crisis. Staff salary will not be regular again. The law now says we need to protect the employees. It's also very possible that that company experiencing financial crisis, that company will not remit staff pension to the relevant authority. That pension is meant for staff. Law says we need to protect employees, cover unpaid pensions. Then we have unpaid taxes. Next in line, we have fees charge, secure creditors. And I try to explain what is fees charge. Fees charge, where a liability is secured on a particular asset of a company, that is fees charge. Where a liability is secured on or with a particular asset of a company, that is fees charge. Now ask yourself, what are the implications of fees charge? In the event that the company cannot pay back the loan, the liability, and the company is to be liquidated, that particular asset, if liquidated, any proceed realized from that asset must be used to repay the particular liability that is secured on it. Any proceed realized from secured asset with fees charge, that proceed must be applied first to settle that liability. You now ask yourself, there seems to be conflicting issue here. Law say give preferential creditors. The law again says if there's a fees charge, proceed from that fees charge must be applied first to that liability. There seems to be lacuna in law. In this case, that fees charge takes precedence over preferential creditors. That particular asset that has been used as collateral for a particular liability cannot be distributed to preferential creditors. We have floating charge, secure creditors. For floating charge, where a liability is secured on the asset of a company, not particular asset now, assets or the asset of a company, that's floating charge. The implication of floating charge is if the company cannot pay back that liability and the company is being liquidated, for floating charge, the liability will continue to float to all the asset, any asset available, until it is fully recovered. We explain redundancy payments, unsecured creditors, preferential creditors, preference shareholders, and ordinary shareholders. Other steps, cash position of the scheme. You have to test for post-reconstruction financial profitability. Then you need to evaluate the attitude of the creditors group. Then you must draw your conclusion. We have taken like 40 minutes to do a recap of last week's discussion. We need to put calculation to this now. We need to put question to this. The principle we have established, the theory we have explained, we need to demonstrate it in calculation. Let us look at illustration 1. Please get your writing material and your calculation, your calculator. The latest statement of financial position of Diamond Nigeria Limited is summarized below. You have the non-current assets, 28.5 million. You have the current assets. Under it, we have inventory and work in progress. You have your receivables. You have your current liabilities. Under it, you have unsecured payables. You have bank overdraft unsecured. Total current liability, 28 million. If you look at current assets, less current liability, we have a negative working capital. A negative working capital is an indication that all is not well with a company, or could be an indication. It could be an indication that all is not well with that company. We have the total assets, less current liabilities. If you look at it, the negative working capital has reduced the total assets. We have liability falling due after more than 1 year. Under it, you have 10% secured debentures, 15 million naira. That 10% is the interest payable on the debentures. Now, a debentures is a liability. Please asterisk 10% secured debentures. That liability is secured on which asset? We need to know. Thereafter, you have your net assets. You have the capital and reserves. Call-up share capital, 20 million naira. Statement of profit or loss. That is a negative profit, loss. Look at it. The company has accumulated loss of 8 million. This has reduced the share capital value. A clear indication that all is not well with Diamond Nigeria Limited. Excuse me, please. All right, I just stopped to take water. Let's continue. Diamond Nigerian Limited call-up share capital consists of 20 million 1 naira ordinary shares issued and fully paid. You must be able to interpret that sentence out. The company has 20 million shares in issue. Nominal price per share is 1 naira. The non-current assets comprise freehold property with a book value of 15 million and plants and machinery with a book value of 13.5. If you look at the statement you are given, non-current asset is 28.5 million. Examiner has explained the component of the non-current assets. Non-current assets comprise 1, freehold property. The book value is 15 million naira. Plants and machinery. The book value is 13.5. If you add the two together, that will give you 28.5 million. Next. The debentures are secured on the freehold property. You can ask yourself. I always encourage students, as you are reading question, examiner is providing indication of what you should expect in your requirements. Debentures secured on freehold property. That is a fixed charge. A liability is secured on a particular asset of a company. That is called fixed charge. The next paragraph. In recent years, the company suffered series of trading losses, which has brought it to the brink of liquidation. The directors estimate that in a first sale of the asset, you can ask yourself, what is first sale? When you first dispose a company asset, you are forcing the company into liquidation. In a first sale of the asset, they will realize the following amount. Meaning the company is liquidated. We can dispose freehold property to get 10 million. We can dispose plant and machinery to get 5 million. We can dispose inventory to get 8.5 million. We can get 8.5 from receivables. Next paragraph. The cost of liquidation are estimated at 3,850,000. However, trading conditions are now improving. And the company directors estimate that if a new investment in plant and machinery costing 12.5 million were undertaken, the company should be able to generate Annual profit before interest of 8,750,000. In order to take advantage of this, they have put forward the following proposed reconstruction scheme to take advantage of new investments and generate annual profit of 8.5. The directors have put forward the following proposed reconstruction scheme. Let's look at the scheme. 1. Freehold property should be written down by 5 million. Plant and machinery by 5.5 million. Inventory by 4 million. Receivables by 500,000. Note 2. The ordinary shares should be written down by 15 million naira. And the debit balance in the statement of profit or loss written off. Next, the secured debentures holder will extend their debentures for 7.5 million ordinary shares and 6.5 million, 14% unsecured loan stock, repayable 5 years' time. The bank overdraft should be written off, and the bank should receive 6 million, 14% unsecured loan stock, repayable 5 years, in 5 years' time as compensation. The unsecured payables should be written down by 25%. A rights issue of 1-for-1 at par to be made on the share capital after the above adjustment has been made. 12.5 million will be invested in new plant and machinery. Requirements 1. Prepare the statement of financial position of the company after the completion of the reconstruction. Now, you have this question to you now. You are required to prepare a post-reconstruction statement of position. This is a direct question. If this company is reconstructed based on the proposal the director has given, how would the statement of financial position look like? Before we go to solve it, is there any aspect of this question that we require further explanation on? All right. I'll request everybody, please get your pen and paper and your calculator ready. Let us have an interactive class. We start with our workings. The first note 1. Freehold property should be written down by 5 million. What is the book value of freehold property, please? Then write it down by 5 million. We have started. I want an interactive class. You can respond via chat. What is the value, the book value of freehold property?
$15 million.
15 million, thank you. Examiner says, write this down by 5 million, meaning deduct 5 million from it. We are left with what?
10 million.
Look at it, please. Non-current assets. Under it, we have freehold property. Book value, 15 million. Write down by 5 million. We are left with 10 million. Next, plant and machinery. Write down by 5.5. The book value of our plants, 3.5 million. Write down by 5.5. We are left with what? 8 million. 13.5 less 5.5. We are left with 8 million. But we still have more information on property and plan. Look at the last note. We can take it simultaneously. 12.5 million will be invested in plant and machinery. So after we have deducted 13.5 minus 5.5, the figure you have to be 8 million. That 8 million plus new investment in plant and machinery, 12.5 million. That will give you 20.5 million. We have been able to take all those notes that affect plant and machinery together. The new investment in plant and machinery, 12.5. If you add it to the 8 million, you have 20.5. I want to believe that is clear enough. Next, still on note 1, inventory and work in progress. Write down by 4 million. Receivables, write down by 500,000. Now go check your statement. That is the statement you are giving. Inventory and work in progress. The book value is 17.5 million. Examiner says write down by 4 million. That should give us 13.5 million. Receivables. The book value is 9 million. Examiner says write down by 500,000. Then you should be left with 9 million minus 500,000. We are left with 8.5 million. We have treated note number, proposal number 1. We have treated proposal 1. Now, that is what we call asset revaluation. The company is revaluing its assets with a view to ensuring that the company remain in business. Recall, capital reconstruction might involve asset revaluation. So we have done asset revaluation here. The company is revaluing its assets with a view to be able to continue in business. Look at proposal 2. The ordinary shares should be written down by 15 million. Now go check the statements you are giving. The share capital is 20 million naira. Examiner says write down by 15 million. So you go to it. The share capital, they are worth 15 million naira book value. Examiner says write it down by 15 million. You are left with what? Call up share capital, 20 million minus 15. We are left with 5 million. What is the implication of this? Existing shareholder may be asked to relinquish part of their shares. The directors are now telling the shareholder that, look, that your investment that worth 20 million naira, please forget it. We are going to write it down by 15 million. It's now worth 5 million naira. Technically, the ordinary shareholder will be losing 15 million naira. Because the company is in financial difficulties. Directors are looking for ways to salvage that company for an eventual collapse. So we have treated this. Examiner says, still in note number 2, the debit balance on the statement of profit and loss written off. That means this 8 million loss. Write it off. Cancel the loss. So note it. We move to note number 3. That note number 2 is what we call existing shareholders are being required to relinquish part of their shares and accept a smaller number of shares. Look at proposal 3. The secured debentures holder would exchange their debentures for 7.5 million naira ordinary shares. Let me ask the class. What is debenture? A liability. Debentures holder has provided loan for the company. In the company's book, that will be shown as liability. What is happening here? Anybody? If the debentures are being converted to ordinary shares, what is happening here? Anybody? Do I need to pick on somebody? Anybody? I believe Fidelis. Ogechukwu. Prosper. Yeah, okay, that's good. She was on live last week also. This is conversion of debt to ordinary shares. Debt capital is being converted to ordinary shares. Somebody has given a company loan. You are now telling the person that, please, so our company is having financial crisis. We can't repay your loan. We want to convert this loan to ordinary shares. Technically, you are trying to say you don't want to repay the loan again. All right, thank you. What they are saying is we don't want to repay your loan again. Oh. We are going to convert it to shares. So you are now part of the shareholder. You are now part of the owner of the business. Remember, reconstruction scheme is a proposal subject to acceptance or rejection. And let's continue. Thank you for that response.
Okay, sir. Please, I want to ask a question, sir.
Yes. What's the name? I like to put a name to it. What's the name?
Fidelis.
Oh, Fidelis. All right, please go ahead.
All right. When the debentures are being converted to ordinary shares, will the investors enjoy every benefits that ordinary shareholders are meant to enjoy?
Would they enjoy benefit more than the ordinary shareholder?
No, not really. Like, will they enjoy the benefits?
Is that your question?
No, will they enjoy the benefits and bear the losses of ordinary shareholders?
Thank you. Yes. Once the debenture is converted to ordinary shares, the debenture's holder will now be collecting dividends. They will not collect interest again. Remember that dividend is not certain. The company may or may not pay dividends, but interest is a must pay. Dividends will only be paid if the company is profitable and the directors are willing to pay dividends. They will enjoy all the privileges and rights of ordinary shareholders. Is that clear, please?
Very clear, sir. Thank you. I appreciate you.
All right. Thank you, Fidelis. Now let's go back to that note number 3. Secure debentures holder will exchange their debenture for 7.5 million ordinary shares and 6.5 million 14% unsecured loan stock, repayable 5 years time. Let's do the analysis. Secure debentures holder in the company's book, the book value is 15 million naira, meaning the debentures holder has given the company a loan that worth 15 million naira. The company is now saying, because they have financial crisis, the company is saying, let us convert part of these debentures to 7.5 million ordinary shares. And also let's convert parts to 6.5 million, 14% unsecured loan stock, repayable 5 years time. Debentures is being converted partly to ordinary shares and partly to unsecured loans. What are the implications of this? If the debentures holder accept this proposal, what are the implications? 1, the debentures holder will immediately lose 1 million naira because the debentures holder has given a loan that worth 15 million. If you now look at the proposal, 7.5 plus 6.5, the naira amount is 14 million naira. That means immediately, if this proposal is accepted, the debentures holder will lose 1 million. Secondly, the debentures holder will now become part of the shareholders in the company. Having a share or having shares that are worth 7.5 million naira. Again, the debentures holder will also be partly debt holders in the company with 6.5 million unsecured loan. but they have to wait for 5 years before the loan will be repaid. That 6.5 million will be repaid in 5 years' time. What is the company trying to do? With this proposal, the interest payable will reduce because the liability will have reduced to 6.5 million from 15 million. That means interest payable will be reduced. Secondly, repayment will now have to wait for 5 years, thereby giving the company the ability to preserve its cash. You know, if a company is having problem, profitability problem, then there's going to be liquidity problem. With this proposal, the company will preserve its cash. Now let's treat this proposal. How do we treat it? Look at it here. Under ordinary share capital, conversion of secured debentures. What you are saying is you are converting debt to ordinary shares that was 7.5. That means debentures holder are now part of shareholders in the company. They have shares that was 7.5. Again, we now have another liability called unsecured loan stock. We have another liability called unsecured loan stock. You can create a note for it, or you can just take it to the statement you want to prepare. 14% unsecured loan stock. Under it, I will now have debentures. What we are saying is debentures holder is entitled to a 14% unsecured loan stock that worth how much? That worth 6.5 million. We have treated that proposal. Proposal 4. Deliberately, we are keeping the pace at an average level to find a way to be able to ensure understanding. Look at proposal 4. The bank overdraft should be written off, and the bank should receive 6 million, 14% unsecured loan stock repayable in 5 years' time as compensation. Let's go check. How much is the bank overdraft? Please look at it here. Bank overdraft is 8 million. Meaning the bank has granted an overdraft to this company called Diamond Nigeria Limited to the tune of 8 million. The company is saying they cannot pay back this overdraft because they have financial crisis. The company's directors are now proposing that, look, let us cancel the overdraft. In exchange, we are going to give you 14% unsecured loan stock that worth 6 million naira. This loan stock is repayable in 5 years' time. Definitely, bank will ask question. Bank will ask itself, what are the implications of this proposal? If accepted, one, the bank will lose 2 million naira automatically. Two, the bank will have to wait for 5 years before they can get repayment of 6 million naira. Remember, overdraft is payable within short-term period. Overdraft is a liability, it's a short-term liability. Now, this company is converting short-term liability to long-term liability. What is the sense in this? The company is trying to push forward a deferment or deferral of liability. They are trying to defer repayment of liability. The intent is to preserve the liquidity position of the company so that the company can continue in business and have freedom of repayment at a future period. Let's treat this now. That means I'll just come here also. Under 14% unsecured loan stock, I will just place bank will also benefit bank. Bank will get a loan stock that was how much? 6 million. %14 unsecured loan stock that was 6 million. Repayable 5 years. Next note. The unsecured payables should be written down by 15 million naira, so by 25%. You now go check the statement you are giving. What is the value of the unsecured payables? Please look at it under current liabilities. Unsecured payables is 20 million. Examiner says, write this down by 25%. Please compute 25% of 20 million and deduct it from 20 million. Please compute 25% of 20 million and deduct this amount from the 20 million. What do you have, please?
$15 million.
Okay, we are left with 15 million. Thank you. Next note, note number 6. A right issue of 1-for-1 at par to be made on the share capital after the above adjustment has been made. You can now pause a minute. What is right issue? Right issue is the issue of new shares to existing shareholders in proportion to the number of shares currently held, usually at a discounted price. Examiner says 1-for-1. For every 1 share in existence, issue one new shares as rights. That is the interpretation of 1-for-1. 1-for-1. For every one share in existence, issue one new shares as a right to the existing shareholder. We cannot go through this. That means we must determine number of shares in existence after the above adjustment. Look at the adjustments. We have 5 million after the adjustment plus 7.5 after the adjustment. That means after the adjustment, we have 12.5 million shares in existence. Examiner now says, right issue 1-for-1. If you have 12.5 million shares in existence, on the basis of 1-for-1, how many new shares are we going to issue as rights? We are going to issue 12.5 new shares as rights. That means after the rights issue, if the company is reconstructed, we are going to have 25 million shares in existence. An examiner says that 1-for-1 is going to be at par, 1 naira per share. That means we are going to generate 12.5 million from the right issue. The existing shareholder must pay for the rights. Technically, under 1-for-1, we have the original shareholder. They have 5 million before rights issue. That means after the rights issue, that means from the rights issue, they will get 1-for-1, they will get 5 million. Technically, the existing shareholder will provide 5 million naira to take up the rights. The debentures holder, based on the reconstruction, they have 7.5 million shares in the company. Under 1-for-1, they will get 7.5. Technically, the debentures holder will provide 7.5 million naira to take up the right issue. If you add 5.5 plus 7.5, that will give us 12.5. That is the money the company will use to purchase new plant and machinery. The cash realized from the right issue will be used to purchase, to invest in new plant and machinery. We are done with the adjustment. We can now go to the statements. We are done with our adjustment. I want to have it together on one page. Yeah. Post-reconstruction statement of financial position. You now look at the workings you have. Under non-current asset, look at working 1. Freehold property worth 10 million. 10 million naira. Plant and machinery after reconstruction worth 20.5. Look at it here. Total asset add 30.5. Current assets, inventory and work in progress. Look at working 2. Inventory and work in progress worth 13.5. Receivables worth 8.5. You can sum up your current assets. That will give you 22 million. It is advisable that you are also doing your calculation at home. In fact, it's good to open your own book and be working it. What you do with your hand, stick faster. Current liabilities. Go check. We only have one remaining. Unsecured loan, unsecured payables. 15 million naira. The bank overdraft has been written off under reconstruction, so we don't need it again. You can now compare your current assets less current liability. That will give you 7 million here. That represents your working capital. Your working capital added to the total assets, you have 37.5 million. That will become total asset less current liabilities. Next, liability falling due after more than 1 year. We have unsecured payables. Unsecured payables, one for debentures holder, 6.5. 14% unsecured payables for bank, 6 million. This is your non-current liability. You have two. You can now compare and get net assets. 37.5 minus 6.5 minus 6. What do you have, please? You are going to get 25 million. That is your net assets. Total assets less total liability. You have 25 million. You can close that. We now come to the capital side. Our capital. The call of share capital for original shareholder, 5 million. Call of share capital for secured debenture holder, 7.5. Right issue. The right issue will be shared by shareholders, the original shareholder and debentures, 12.5. Total share capital after reconstruction. You can pick it. You can pick it straight from here. 25 million. Your balance sheet will balance, or your statement will balance. Net asset 25 million. Capital share, color share capital 5 million. The statements of financial position after the completion of the reconstruction will look like this. You are done with requirement A. You are done with requirement A. Any question, please? Any question, please? All right. Let us look at requirement 2. Look at requirement 2. Requirement B. Prepare a report, including appropriate calculations, discussing the advantages and the disadvantages of the proposed reconstruction from the viewpoints of 1, the ordinary shareholder, 2, security debentures holder, 3, bank. In your own view, how can we discuss the advantages and disadvantages of the proposed reconstruction scheme from the viewpoint of the following stakeholders? What do you think the examiner is trying to ask? Or let me put it straight. Assuming you are faced with this in the exam, how you need to navigate and respond to the examiner? The line is open. The line is open. Let us try. Let's ask ourselves. We are waiting. Anybody can speak. You can signify by raising up your hand, speak, or you can send in a chat. Let's have an interactive class. What's the examiner trying to text here? The class is silent. All right. Now, the company has proposed a reconstruction. And that reconstruction is to stakeholders. Who are the stakeholders? Stakeholders, people that have vested interest in the company. Stakeholders, people that are likely to be affected by the company's decision. They are the stakeholders. If you now want to discuss this, the company is proposing to the shareholders that let us write off 15 million of your shares. Definitely, the shareholders' investments will reduce. The shareholder will suffer 15 million naira. That means from the surface, my investment that was 20 million, you want me to suffer 15 million naira. You are also asking me to bring in 5 million naira to the business as rights issue. I should bring in more money to the business. Assuming you are the shareholder, you must ask questions. Now wait. Is this reconstruction favorable to me? For you to answer that question correctly, as a shareholder, you now say, okay, if this company is liquidated, say, if I don't accept reconstruction and the company is liquidated and the asset of the company disposed, what can I benefit? For you to appreciate the proposal, you must ask yourself that if that company is liquidated and the asset realized, what am I going to benefit? You can now compare it with the proposal the director is giving you. You cannot dictate the advantages or disadvantages of the proposal. Secure debentures holder will do same. That if this company is liquidated, how much can I get? If this company is reconstructed, what value will I get? The debentures holder will not be able to know if the reconstruction scheme is advantageous or not. Same apply to bank. You must prepare this, or you must present this in the form of a report. You can now prepare your report in report format. The letterhead of the company. You can use any company of your choice and also form a name. Look at the company's name that we have adopted. Dominant Consulting and Financial Services. The company's location. I just cut it, not too important. You are writing to the managing director of which company? The managing director of Diamond. Create an address for it. The topic is proposed liquidation or reconstruction or restructuring of Diamond Nigerian Limited. You now start your report. Remember the report you are writing. Examiner says prepare a report, including appropriate calculation. Examiner knows that these reports include extensive calculation. Remember, you are going to consider two positions. If the company is liquidated and the asset disposed, how much will ordinary shareholder benefits? How much will secure debentures holder benefits? How much will bank benefits? Because examiner has given you three stakeholders. Are we good to go with the reports? I think so. I think we are good to go. In order to be able to make I'm looking at the reports. In order to be able to make a critical review of the proposed reconstruction of your company, from the viewpoints of the following stakeholders, list the stakeholders out. Examiner has given us the stakeholders, list them out. Ordinary shareholders, secure debentures holder and bank. It will be necessary to prepare detailed analysis of the reconstruction under liquidations and under the suggested restructuring. What the next paragraph is saying is, it is necessary to prepare detailed analysis of the reconstruction scheme under position 1. If the company is liquidated, position 2, if the company is restructured as suggested by directors. This is not needed here. Only used to explain. You are trying to explain to the company and the examiner that it is necessary to prepare detailed analysis of the reconstruction under 2 headings. Heading 1, liquidation. Heading 2, the company's restructure as suggested by the directors. We now move to the next line. In case of liquidation, that is, if the company is liquidated, the position of the company will be as follows. What we are saying is, if this company is liquidated, how much can we realize from the sales of the assets? We now go back to the question. If the company is liquidated, how much can we realize? Can we go back to it? We can realize how much? Freehold property, look at it. The director estimates that in a first sale of the assets, they will realize how much? From freehold property, 10 million. Plant and machinery, 5 million. Inventory, 8.5. That is, in the case of liquidation, the company will realize the following. Plants, 5 million. Inventory, 8.5. Receivable, 8.5. Total amounts realized, 22 million. You now ask yourself, in the question, do we have liquidation expenses? Are we going to incur any cost to dispose the assets? Examiner says cost of liquidation are estimated at 3.3,850,000. That means the company will incur cost to be able to dispose the company's assets. That must be deducted from the amount realized. Amount realized, 22 million, less liquidation expenses, 3,850,000. Amount available to creditors, 18,150,000. You observe that we didn't include freehold property. The proceeds from freehold property is not included. Why? Who can tell me why this is not included in the amount realized? In the other amount realized? Why? The freehold property has been used as collateral for a liability. Look at it here. Debentures are secured on freehold property. That means if the company is liquidated, the proceeds from freehold property must be used to settle debentures liability first. That proceed cannot be given to another person, cannot be given to another creditors. It must be given to debentures holders first. That is the reason why the proceeds from freehold property is not added to other proceeds. You must be able to ask questions. Okay, please note that. Look at the next line. 10% secured debentures. This is secured with freehold property. With book value of 15 million naira. That is, the book value of the freehold property was 15 million. Could only realize how much? 10 million. Therefore, the 10% secured debentures holder will realize the security of 10 million naira. That 10 million naira will be given to the debentures holder. The debentures holder has given us a loan of 15 million naira. This loan is secured on freehold property. If the company is liquidated and that freehold property is disposed, any cash realized from it must be applied first to settle the debentures liability. That means out of the loan, the debenture has given the company 50 million. The debentures holder will get 10 million naira cash. Thereafter, claim the balance of 5 million. The debentures holder will claim the 5 million alongside other unsecured creditors. Because the asset is not sufficient to repay the liability, the debentures holder will now go and join other unsecured creditors to claim the balance of 5 million naira. I hope that explanation is clear enough. Any question, please? If you are following this class, the lecture, we have started distribution. In this question, there is no preferential creditors. Next, we move to secure fixed charge secure creditors. the 10 million naira from freehold property will be applied to settle secure debentures holder. Debentures worth 1 million naira. Thereafter, debentures holder will claim the balance of 5 million alongside other unsecured creditors. So we have settled fixed charge secure creditors. In this question, we don't have floating charge. In this question, we don't have redundancy payments. Next is the list we explain. After redundancy payments, we have unsecured creditors. Look at it here. In this case, the total outstanding liability payables, that is the total unsecured creditors. You can use that. The total unsecured creditors. The total outstanding unsecured creditors will be as follows. Now let's go and check. If the company is liquidated, that means the company is not reconstructed. So if you are talking of company liquidated, you are going to be looking at the original statement you are giving. Our unsecured creditors, we have 1, unsecured payables. It was 20 million naira. We have bank overdraft unsecured. It was 18 million naira. And we have balance of outstanding balance from, look at it here, secure debentures. Let's look at this. The total outstanding unsecured creditors will be as follows. Unsecured payable 20 million. Bank overdraft unsecured 8 million. Balance payable to secure debentures 5 million. Totaling 33 million. These creditors, look at it. We need to settle 33 million naira. We only have how much? 18 million 150. Definitely, the cash available is not sufficient to settle the total outstanding unsecured creditors. How do we share it? This is not too important. This creditor, we have to share the sum of 18 million 150, which is the amount available to creditors as earlier calculated. The amount available will be shared as follows. We now need to prorate because the money cannot go round. How much we secure debentures, how much we unpaid unsecured payables get. Look at it. Unsecured payable is 20 million. Unsecured payable is 20 million. You now say 20 million over the total, 33 million, multiplied by the amount we are going to share. We are now prorating 20 over 33 multiplied by 18,150,000 to the nearest million. Unsecured payables, we collect 11 million. Bank, how much you bank collects? 8 million divided by 33 multiplied by 18,150,000. Bank will get 4.4 million. Debentures holder, they have 5 million remaining. That becomes 5 over 33 multiplied by 18,150,000. Debentures holder will get 2.75 million. That means we have shared 18,150 million. No cash is remaining. The summary of our sharing. In the examiner says 3 stakeholders. We have finished sharing money now. That means ordinary shareholder will not get anything if the company is liquidated. The stakeholders, 1, ordinary shareholders. If this company is liquidated, the ordinary shareholder will receive nothing. Number 2, secure debentures holder. If this company is liquidated, secure debentures holder will receive 10 million naira. That is from the realized assets secured. That is the 10 million naira from where? From where, please?
Leasehold assets.
Yeah. That is the proceeds from freehold property. Secure debentures holder will receive 10 million. That is from the realized assets secured. And the debentures holder will also get 2.75 million. That means in total, secure debentures holder will get 10 plus 2.5. Secure debentures holder will get 12.75 million. Thereby losing how much? Out of 15 million naira, the debentures holder has given us loan. If this company is liquidated, the debentures holder will get 12.75 million, thereby losing 2.25 million. Bank will receive 4.4 million based on what we share here. Bank has given a loan of bank overdraft of 8 million. If the company is liquidated, bank will get 4.4 million. Thereby losing how much? 3.6 million. We have looked at if the company is liquidated. Now we want to look at if the company is reconstructed. We have looked at if the company is liquidated.
So please, this 0.55, how did you get the figures, sir?
Okay. I was using it to explain to a class, but it's not a must. You can remove it. You understand? But how we got it, what I did, is not a must to have it there. I just want to show you another means of calculating the 2.75.
Okay.
You know, we got it from here.
Yes, sir.
It's another means. You can just say, you can say 18,150,000 divided by 33 million. That will give you 2 points. That will give you, oh, please divide. 18,150,000 divided by 33 million. What do you have?
Okay. Okay, that's 0.55.
Now, if you don't want to go through this 20 over 33, just come here, multiply 0.55 multiplied by 20 million. What do you have?
That's 11 million.
That is the 11 million unsecured payable we collect.
Okay.
Go to bank, multiply 8 million by 0.55.
Yeah, 4.4.
That is the 4.4 million bank we collect if the company is liquidated. Take the 0.55, multiply by the 5 million for debentures holder remaining. What do you have?
That's 2.75. Yes, sir.
That is the shares debentures holder we get. I was just using it so you can form your notes. Different way of calculating how to get your figure here. I hope that is clear.
Yes, sir. Thank you, sir.
Now we move to the next paragraph. That is the second position now. If the reconstruction succeed, that is, if the company is reconstructed and the reconstruction succeed, you see it now. You know, we have looked at if the company is liquidated. We have been able to identify what shareholder we get, nothing. What secured debenture holder we get, 12.75 million. What bank we get, 4.4 million. Alternatively, if the reconstruction is undertaken, the statement of financial position of the reconstructed company as an attachment, that is solution 1. Now refer the examiner to solution A. If the company is reconstructed, this is the statement of financial position. You are going to reference this as an attachment in your report. You are now trying to refer the examiner to look at. Is that clear, please? Good. Okay, any question?
No, sir.
Okay. However, should the proposed annual profit before interest of 8.8 million be achieved, we are saying that if the proposed annual profit before interest of 8,750,000 is achieved, the company's statement of profit or loss will be as follows. You know, it's a proposal. The company should invest in new plant and machinery. The company will generate annual profit before interest of 8,750,000. Look at the way it was constructed. should the proposed annual profit before interest of 8,750,000 be achieved, the company's statement of profit or loss will be as follows. Look at as follows. Profit before interest and tax as given, less interest. If this company is reconstructed, please check. Do we have liability that the company will pay interest on? Please check. If this company is reconstructed, are there long-term liabilities that the company will have to pay interest on? Please go and check post-reconstruction position. Please go check post-reconstruction statement of financial position. Do we have liabilities? Yes. Look at it now. %, unsecured loan stock, 6.5. That means this company must pay interest. Compute 14% of 6.5. That is the interest to be paid on the unsecured loan stock. This interest will be received by debentures holder. Again, 14% on 6 million. The second interest paid by the company to be received by bank. Look at it here. Less interest. This compute the interest 14% of 6.5. That will give you 910. 14% 6 million. That will give you 840. Now let's deduct the interest. Deduct the interest, you have 7 million. In this question, there is no taxation. That means that 7 million represents profit after tax. That 7 million represents profit after tax. The profit after tax is the money meant for ordinary shareholders. The profit after tax is the money meant for ordinary shareholders. That means if this company is reconstructed, the company can achieve a profit after tax of 7 million naira. How are we going to share these profits? How are we going to share the profits? Remember now that if the company is reconstructed, we have two categories of shareholders in the company. If this company is reconstructed, we have the original shareholders. And we have secure debentures holder who are now part of the company as shareholders. Before rights issue, the original shareholder, they have 5 million. We now say right issue 1-for-1. That means if they follow 1-for-1, they are going to get additional 5 million shares. That will make their shares 10 million after reconstruction. Before right issue, secure debentures holder have 7.5 million shares. on the basis of 1-for-1 right issue, they will get additional 7.5. That make their share 15 million. That's what we explain here. Percentage shareholdings. Original shareholder we have after the right issue. They have 10 million shares. Secure debentures holder have 50 million shares. Total share in the company, 25 million. You can now calculate percentage of holdings. How do we get this percentage? 10/25 multiplied by 100. That will give you 40. Next, 15/25 multiplied by 100. That will give you 60. That means technically, if this company is reconstructed, the original shareholder will have just 40%. While the ventures holder will have 60%. Technically, the company now belongs to the ventures holder. Is that clear, please? Please, you are going to write now. Although you are going to have I want to explain the last aspect. The next discussion, in this case, position of the stakeholders will be as follows. Should the reconstruction succeed, you can take down if you have it. Or let's say evaluation of the proposed, please, a small subheading. Put it there. If I want to take this off. Evaluation. Evaluation of the proposed reconstruction. Reconstruction from the viewpoints from the viewpoints of the following. Stakeholders. 1, the ordinary shareholders. If it is possible, if it is convenient, jot down. Evaluation of the proposed reconstruction from the viewpoint of the following stakeholders. 1, if it is possible and if it is convenient, take a note and jot it down. 1, the ordinary shareholders. If the company is liquidated, if the company is liquidated, the ordinary shareholder will receive nothing. If the company is liquidated, the ordinary shareholder will receive nothing. On the other hand, if the company is reconstructed as proposed, on the other hand, if the company is reconstructed as proposed, the ordinary shareholders will be required. The ordinary shareholder will be required to make additional investment of 5 million naira in the reconstructed company, to make additional investment of 5 million naira in the reconstructed company in order to take up the rights issue. In order to take up the rights issue. Full stop. In effect, the ordinary shareholder will now own 100 million shares, representing 40%. In effect, the ordinary shareholder will now own 10 million shares, representing 40% shareholdings in the reconstructed company. They will be entitled to 40% of the profit after tax. The ordinary shareholder will be entitled to 40% of the profit after tax from the reconstructed company. Open a bracket. Please compute 40% of 7 million. What do you have?
$2.8.
This explains the 2.8 million you are seeing here. Now let me ask the class. Based on the notes, based on the notes I've given just now, should the ordinary shareholder accept reconstruction? Or should they accept liquidation? What will be your advice?
Construction.
Okay. Why?
Because at liquidation, they would have nothing.
Okay.
But reconstruction, they would have 2.8 million naira, even though they would lose controlling interest.
Oh, that's great. Any other opinion? That's fine. Look at the last aspect here. It will appear that the reconstruction is in the best interest of the ordinary shareholders. However, this will depend on the validity of the profit forecast. If the profit forecast turns out to be wrong, the shareholders stand to lose further on their investments. You know that profit is a forecast. There is no guarantee that if the shareholder provides 5 million, the company will make a profit. It's a forecast that if you can give us 5 million, we should be able to make a profit of 8,750,000. There is no guarantee. How that is clear enough. So you are going to put a statement like that. It will appear that the reconstruction is in the best interest of the ordinary shareholders, but the validity of the profit forecast is important. If the profit forecast turns out to be wrong, the shareholders stand to lose further on their investment. Next, number 2, we move to secure debentures holder. If the company is liquidated, the maximum amount the debentures holder can collect is 12,750,000. If the company is liquidated, the maximum amount the debentures holder will collect is 12,750,000, thereby losing 2,250,000 immediately. Thereby losing 2,250,000 immediately. Alternatively, if a reconstruction is agreed to, secure debentures holder will be required to make further investments of 7.5 million naira to take up the rights issue. In exchange, they will receive interest income of 910,000 on the unsecured loan for 5 years. In exchange, they will receive interest income of 910,000 on the unsecured loan for 5 years. At the end of the 5th year, they will receive 6.5 million. In addition, the debentures holder will receive 60% of the profit after tax from the reconstructed company. Please compute 60% of 7 million. Please compute 60% of 7 million. What do you have?
$4.2.
All right, thanks. That means the debentures holder will get share of profits. The debentures holder 4.2 million. The debentures holder will interest income on unsecured loan 910. Total earnings 5,110,000 annually. Again, the debentures holder now have 60% the company. That means they are now the majority shareholders. Now let's ask ourselves, is this reconstruction favorable to the debentures holder or not?
Favorable.
It's favorable. So are you recommending that they should accept reconstruction? Are you recommending that the debentures holder should accept reconstruction?
Depends on the outcome of the profit focus as it is in the ordinary share.
Okay, that's intelligent now. Because there's element of risk. The debentures holder will bring more money to the business, 7.5. Need to state that also, that although the reconstruction appears to be in the best interest of the debentures holder, however, this will depend on the reliability of the profit forecast. This will depend on the reliability of the profit forecast. Where the profit forecast turned out to be wrong, the debentures holder will suffer more. Finally, bank. If the company is liquidated, bank will only receive 4.4 million naira. If the company is liquidated, bank will only receive a maximum of 4.4 million naira, thereby losing 3.6 million naira. On the other hand, if a reconstruction is undertaken, the bank overdraft of 8 million naira will be cancelled, and the bank will accept 14% unsecured loan stock of 6 million naira, repayable 5 years time. With reconstruction, the bank will lose 2 million immediately. But the bank will be getting a higher interest of 14%. The bank will get 14% of 6 million, that is 840 for 5 years. And the bank will receive 6 million naira, the principal amount in 5 years. So what will be your advice to the bank? Should the bank accept reconstruction or liquidation?
Liquidation.
Why do you say?
Because they will receive more at liquidation than construction. Mm-hmm.
It makes sense, but you must always put that reservation. If the company is not achieving that profit, the bank will get nothing. No. The last paragraph, it is clear that from the two cases, secured debentures would have benefits most, whether liquidation or reconstruction. However, the reconstruction is the best option for the company and should be pursued. You now put your closing remark and sign up for the company. That is how to tackle question on capital reconstruction. We are done with our question. We have about 13 minutes. The line is open for questions. Otherwise, we call it a good night.
Hello, sir. The last person that answered that, he says the bank will consider liquidation. But I believe based on this explanation that at the reconstruction, they will have interest of 40% of 6 million. That's 840 plus the capital. That's 6.8. I think the reconstruction will be better or liquidation in this case.
And that was what the person said now.
Okay, I thought he said liquidation.
No, he said they should reconstruct. They benefit more from reconstruction.
Okay, thank you.
So please, the topic, if you understand this very well, because there are going to be an assignment after, you can take home and look at it. I should share after the class. I will share an assignment with you after the class. If you understand the concept very well, it's a technical analysis that once you understand this, you can deal with any question on it. Once you understand it, examiner can only change figures. Principle will not change. All right. If there's no question, we shall call it a good night. Let's start taking our reading from now. Let's not wait till May. May God give us a better understanding. Let's have a blessed evening. Good night.
Thank you, sir.
Thank you, sir.
You're welcome, please.
Thank you, sir.